There are three simple numbers that have guided some of the greatest investment decisions in history. Today I'm going to share them with you. These are the three metrics Warren Buffett keeps coming back to time and time again when he evaluates any stock. But here's what I'm going to do that's completely different from every other video you've seen on this topic. Most of them oversimplify this to the point of being dangerous. They tell you, hey, just check out these three numbers and you're done. That's not how Buffett actually works, and if you invest that way, you're going to get burned. Okay. Todd Combs, one of Buffett's investment managers at Berkshire, he said something at an event in 2022 that really stuck with me. He said 98% of what he and Buffett discuss is qualitative. The numbers are just a starting point, not the finish line for the discussion. So today I'm going to show you how to use each of these three numbers the right way, where each one of them can fool you, and what Buffett actually does beyond them that most people never talk about but should. By the way, I'm Steve Reitmeister. I spent over a decade as editor-in-chief of Zacks.com, and I'm currently a partner at WallStreetZen, where I help create the Zen ratings. This is a market-beating quant rating system that distills 115 factors into actionable buy, sell, and hold recommendations. So if you're interested in the theme of this video, then please hit like so I know to plan more topics like this in the future. First, let's provide a little context on these three numbers. As you may have noticed, Wall Street loves to make things a little overcomplicated. Fancy jargon, 40-page research reports, endless talking heads contradicting each other in CNBC, and there's a reason for that. Okay? The more confused you feel, the more you think that you need them to manage your money. Buffett has spent 60-plus years proving the opposite. But I want to be honest with you up front. These three metrics are a fast way to eliminate bad stocks from your radar, so best to think of them as a first filter. If a company fails any one of these tests, you can just move on and save yourself from a big mistake, okay? Whereas passing all three doesn't automatically make it a great investment. It just means it's worthy of further investigation. Okay, with this backdrop set, let's start with the first number. Not surprising to anyone who follows Warren Buffett, but we start our journey with return on equity, better known as ROE. Here's the simplest way to think about ROE. If you gave a company $100 of your money, ROE tells you how many dollars of profit they generated with that money. Thus, a company with a 25% ROE turned your $100 into $25 in profit. Now, why does Buffett care so much about this metric? Because ROE is essentially a measure of management's quality. It tells you whether the people running the business are actually good at what they do. Kind of important, right? Are they allocating capital well? Do they have pricing power? Is there something about the business, a brand, a network effect, a cost advantage that lets them earn more with less? Now, let's take Costco, for example. Over the last 10 years, Costco's average ROE has been around 26%. Now, right now, it's closer to 30%. That's incredibly healthy and consistent. Year after year, Costco generates outstanding returns on the money shareholders have invested with them. Now, this is the same signal Buffett saw when he bought See's Candies back in 1972 for a lowly $25 million. That little candy company was earning a 60% pre-tax return on invested capital. Now, it didn't look that exciting on paper, $31 million in revenue and just $4 million in profit, but that ROE told Buffett everything he needed to know about the quality of the business. See's has since generated over $2 billion in cumulative pre-tax earnings for Berkshire, all from that original $25 million investment. So, what's the threshold for ROE? In his 1987 shareholder letter, Buffett laid it out pretty clearly. He wants to see ROE consistently above 15 and ideally above 20, sustained over a full decade. One good year means nothing. It's the consistency over time that truly matters. But here's where this number can fool you. So listen up, because this one's kind of critical. A company can artificially inflate its ROE by loading up on debt. When you borrow money and buy back shares, shareholders' equity shrinks. And when equity shrinks, ROE goes up, even if the underlying business is actually getting worse. Okay, IBM is the textbook example. Between 2005 and 2015, IBM spent roughly $125 billion on share buybacks, largely funded by debt. Revenue actually fell from $106 billion to $81 billion during that period. The business was deteriorating, but because they kept shrinking the equity base, ROE looked respectable on paper. If you only checked that one number, you might have thought IBM was doing great and worthy of investment. Meanwhile, the stock delivered negative returns from 2013 to 2024. That's why Buffett never looks at ROE in isolation. He wants to know how the company is achieving that return. Is it from genuine business excellence, or is it from financial engineering? And that brings us directly to number 2. Real quick, before we move on, do me a favor and subscribe and hit the notification bell. That's because I put out new videos and stock picks every week, and that's the best way to stay up to date. Okay, on to the second number, which is debt to equity. And this one ties directly to one of Buffett's most famous quotes. Rule number 1, never lose money. Rule number 2, never forget rule number 1, right? Everyone loves that one, as they should. Debt to equity is how you follow that rule. It tells you how much of a company's funding comes from borrowed money versus shareholders' money. A debt-to-equity ratio of 0.5 means that for every dollar of shareholders' equity, the company has 50 cents of debt. That's pretty conservative. A ratio of 2.0 means that they've borrowed twice as much as shareholders have put in. That's a bit aggressive. Buffett has another famous quote, "Only when the tide goes out do we discover who's been swimming naked," right? Debt to equity is how you check before the tide goes out. There is no better cautionary tale than Bed Bath & Beyond. In 2017, their debt to equity was 0.55, perfectly fine. Shareholders' equity was a healthy $2.72 billion. But then watch what happens next. By 2021, the ratio has climbed to 0.93, still technically under 1, so a lot of investors weren't paying that much attention yet. But by 2022, it explodes to 6.99. Shareholders' equity had collapsed from $2.72 billion to just $174 million. Then the company filed for bankruptcy by April 2023. If you had been watching this one number over those 5 years, the warning signs were screaming at you before the stock went to 0. Buffett generally wants to see debt to equity below 0.5 for most operating companies. He'll make exceptions for financial companies like banks where leverage is a more integral part of their business. Now, debt to equity doesn't tell you the quality of the debt. There's a big difference between long-term fixed rate debt locked in at low rates versus short-term variable rate about to reprice and harm the company. The ratio looks the same, but the risk profiles are completely different. It also doesn't tell you if the business is growing. A company can have 0 debt and still be a terrible investment if revenue is shrinking and customers are leaving in droves. So debt to equity answers the survival question. Can the business weather a recession? Can it handle a credit crunch? But it tells you nothing about whether the business is actually worth owning at any price. And that brings us to the third and final number. Now, but first, before we get into that, let me chime in and say that if you're confused about where to find any of these numbers, just look at the ticker page for any stock on WallStreetZen.com. You'll see all these numbers and much more. The link is in the description or scan the QR code. Okay. On with the show. The third number is price to earnings, or PE. This is probably the most widely used metric in all investing and also the most widely misunderstood. PE tells you how many dollars you're paying for each dollar of a company's annual earnings. So if a stock trades at $100 per share and earns $5 per share, the PE is 20. You're paying $20 for every dollar of current earnings. Lower PE means you're paying less per dollar of earnings, and higher PE means you're paying a premium. Now, this is where investors get into serious trouble. Intel in 2020 and 2021 had a PE ratio of around 10 or 11. On paper, it looked like a bargain compared to the 20 to 25 PEs for the average S&P 500 stock. Looks like a bargain, right? Dead wrong. Okay. There's a very good reason it was this cheap. Earnings per share went from $4.50 in 2021 all the way down to negative $4.38 by 2024. The stock fell from over 60 to under 19. That's called a value trap. Sucked in by a low PE only to find out the business is falling apart. Now, let's flip the script. Apple in early 2016 had a PE around 10.6. The market was treating it like a declining tech hardware company. Todd Combs confirmed that Apple kept showing up when he and Buffett ran their Saturday Litmus test, which was looking for S&P 500 companies trading at 15 times earnings or below with high confidence of a long-term compounding of growth and share valuation. Buffett started buying at an average price around $39 per share. Today, that investment is up over 600%. Right? It's the same PE as Intel, yet a completely different outcome. The difference was that Apple's earnings were about to accelerate as its services business kicked into high gear, while Intel's earnings were about to collapse. So the lesson isn't buy low PE stocks. The lesson is always to ask why the PE is at such low levels. Okay, is it cheap because the market is temporarily panicking, or is it cheap because the business is broken? That distinction is worth a lot of money in knowing, and if for a guy like Warren Buffett, worth billions. All right. So here's quick proof that all three numbers work together. When Buffett bought Coca-Cola in 1988, ROE was running around 27 to 30%, debt was low, and the PE was in the mid-teens. All three numbers checked out, and now that position is worth over $25 billion to Berkshire Hathaway and its shareholders. Same story with American Express. Back in 1964, the stock crashed 43% during the famed salad oil scandal. Everyone was panicking, but Buffett stayed calm enough to check the numbers, including having a guy sent out to see if people were still using their Amex cards at restaurants and hotels. The answer was a hearty and solid yes, just business as usual. Buffett put a whopping 40% of his fund into this one stock. It's still one of Berkshire's largest holdings. So let's pull this all together. ROE tells you if it's a good business. Debt to equity tells you if it's a safe business. PE tells you if you're paying a fair price for shares. If any one of these three fails, it's over for that stock. I may not be as seasoned nor as famous as Buffett, but I've been investing for over 40 years, and here's what that experience has taught me. These three numbers are most certainly important, but it's not the end-all, be-all. Here's what they're missing. First, momentum. A stock can pass all three tests and go completely nowhere for years. It can be an accelerating downtrend. Buffett can afford to wait, right? He's got that kind of patience. He's sitting on $300 billion in cash. Most of us need to see a faster rate of return. Second, earnings trajectory. ROE tells you what happened. It doesn't tell you where the company is headed next. A company can have 5 years of great ROE and be about to see declining earnings. Third, sentiment and smart money. What are the institutions doing? What are insiders doing? Because if insiders are dumping shares of a company that passes all three tests, then you need to heed that ominous warning. And here's one more thing the three numbers completely miss. Industry context. A stock can look phenomenal on all three metrics, but if the entire industry is in a secular decline, then you're simply buying the best cabin on the Titanic. Think about Blockbuster in 2005. Solid financials, but the industry was being eaten alive by Netflix and other digital streaming companies. The numbers looked backwards, yet the world was moving forward. This points out how vital it is to have a stock selection system that also accounts for where things are headed next. And this is exactly why we built the Zen rating system at WallStreetZen. It goes way beyond Buffett's simple three numbers tests. All in all, we review stocks across 115 different fundamental factors. We're talking about 26 financial health metrics, 22 growth factors, 21 valuation measures, plus other factors in momentum, sentiment, safety, and even our proprietary AI-driven signals. We boil all these insights down into an intuitive A through F rating. So not only does every stock have an overall letter grade, but you can also see the individual component grades for all the key areas I just mentioned. Think of it this way. Buffett's three numbers are like checking your blood pressure, heart rate, and temperature. Vital signs, sure, essential. But your doctor doesn't stop there. The Zen rating system is like running a full diagnostic, and the A-rated stocks using the system have averaged over 32% annual returns since 2003. By the way, if you want to see some of the best stocks being flagged by our system right now, then claim your free copy of our special report, 3 Stocks to Double This Year. I'll drop the link to the report in the description below, or just scan the QR code. Let's finish up by discussing how to put everything we discussed into practice. Step 1, use the Buffett's three numbers as your first filter. ROE above 15 for the past 5 to 10 years. Debt to equity below 1 for a non-financial company. And PE significantly below the stock's own 5-year average and its sector's peers. Do keep in mind that the S&P 500's average PE right now is over 20, with many beloved mega caps over 30. So rigid cutoffs on PE from old textbooks don't work in today's market. Well, we want to consider what is going on right now. Any single red flag is enough to take a pass on a stock. Just remember, there are literally thousands of stocks out there, so be patient enough to only pick the best ones. Step 2, if a stock passes all three, then time to dig deeper into the trends. Is ROE stable or declining over the 5 to 10 years? Is debt creeping up? Has the PE expanded because earnings are growing, or because the price got ahead of itself? Step 3, look at what the three numbers don't cover. Is the stock in an uptrend? Are Wall Street analysts upgrading or downgrading? Are insiders buying with their own money or selling into the strength? Now, you can do all this work manually, but gladly there is a better way. This brings us back to the complete 115-factor review by the Zen Ratings Quant model. A-rated stocks are in the top 5% and are truly the best of the best, given 32% average annual returns for those shares. And yes, the link to the Zen Ratings is in the description below. Here's the bottom line. Buffett's three numbers are generally valuable. They've been proven over the decades. It's a solid first filter in investing. But investors who only check those three numbers are too often buying stocks that are value traps, or dead money stocks for years, or simply missing warning signs right before they blow up. The three numbers get you started. A complete system like the Zen Ratings gets you in the winner's circle. Now, drop me a comment below. Tell me which of these three numbers you use the most, and perhaps others that you rely upon for your stock analysis. And if you want to learn more about Warren Buffett's approach, then I broke down the most important rules he learned from his investing mentor in this next video.